Thanks for having me again, and thanks everyone for coming today. I'm going to talk about a couple of real simple but effective swing trading strategies, and then I'm going to get a little deeper and talk about how I take concepts like are in these strategies and improve on them for myself, and I'll talk about kind of the power of combining things. It's big concept, it's some simple strategies, and hopefully you'll be able to take away some ideas. Before I get into it, if you've been trading for any period of time, probably even since this morning, you know that the market can be volatile and that there are risks involved in trading. A lot of the information I'll be showing here today also is back-tested. So I found a lot of value in back-testing over the years. It helps me learn about the market. It teaches me how the market typically performs and allows me to design strategies. Of course, it doesn't always work going forward exactly as it worked in the past, so there are risks involved, as there is with any market. I think this was covered mostly in the introduction, so I'm not going to spend too much time on myself here. I trade the biggest portions of what I trade are using swing or overnight trading strategies. I don't do a lot with intraday trading. I don't do a whole lot with long term. Most of my trades last between 1 and 5 or 6 or 7 days. And sometimes shorter than that. You know, it might be 2 or 3 days and I'll be out of a trade if it quickly goes in my direction. I do institute overnight strategies as well, and they're part of InvestQuant as well. I'm not going to be talking about them so much today. Today I'm going to focus on swing trading ideas. I'll show this at the end also, but there's an opportunity to go and sign up for a free trial of the Swing Navigator, which is a nightly letter I write that examines InvestQuant's swing edges systems. And I'm going to talk about them a little bit in the presentation as well. But it'll give you an idea of, you can take a free trial. The letter's done very well over time, and you can see if it works for you without costing anything. All right. So 2 simple and effective swing trading strategies and how to improve them. I will note that if you have questions throughout the presentation, if it pertains to a particular slide I'm on, if I'm not explaining something properly, please go ahead and ask. And I'll do my best to answer those questions as I see them come in. If you have more general questions, I'd ask that you hold them towards the end of the presentation. I will have plenty of time at the end of the presentation. It's not going to take me the full 45 minutes to go through all this. I generally like to allow for 10 or 15 minutes of Q&A at the end of these presentations. So we should have plenty of time to answer whatever questions you have. All right, let's get on to the good stuff. Okay, simple strategy 1. You know no rules here, but I will tell them all to you in due time. So what this is doing, this is what I refer to as a swing trading strategy, where we're looking, and this one is basically looking to buy dips, and then it's going to sell into rallies, right? And there's plenty of different ways to do that, and there's different ways to identify what a dip is, and then oversold, overbought measurements. And that's effectively what this is doing. You can see we got a buy here, the market moves up and we sell into that, another buy down here, sell into this rally, another buy down here, sell into that rally. Here, that one was timed pretty good. This one as well. Oh, that's a nice rally there. Buy the dip here, up there. So works a lot. Sometimes it doesn't work. So here at the end of this chart, what we see, and this chart it's a couple of years old, but it's a daily of the SPY. You get a dip and it's bought, and the rally didn't come too soon here, right? So you had to endure some pain, and then it was sold into that area of the rally. So overall, looks pretty good. Not always winners, but not bad. So what is the strategy? I call this my 5-day low, 5-day high strategy. All right, and it's really pretty simple. So this is for the SPY, which is the S&P 500 ETF for those that aren't familiar. What we're doing is we're looking at today's closing price in relation to the previous 4 days. So if today's price is the lowest closing price in that 5-day group, another way of saying it is we're closing at a 5-day low, I'm going to look to enter long tomorrow morning using a limit order of today's close, right? So if it gaps up and just runs all day, I'll miss out on this. But if it gaps down, I'll get a better entry than today's close. And if it gaps up a little bit and then pulls back, or it gaps up large and pulls back, whatever, as long as it pulls back to today's close, at some point during the day, I'll be in there. All right, so I'll miss out on some trades. I'll get most of them, and I'll get a good fill on a fair amount by waiting till the next day to go in rather than just buying it at today's close. Okay, the exit rule. Again, we're looking at today's closing price in relation to the previous 4 days. And if we're at the highest closing price of the group of 5, we're going to exit at the close. All right, so really all you need to know is what was the closing price of the previous 4 days, yesterday, day before, and day before that. And then you put in a limit sell order at the highest closing price of the last 4 days. If it gets sold at the close today, you're out. So here's an example. Number 2 was a 5-day low close here. We bought the gap down the next morning, or it would have been bought using this method, right? And then it would have been held for 1, 2 days. At day number 5 here, what you see is that's the highest close of the last 5 days. It's higher than 1, 2, 3, 4, 5 is the highest. So that's where it would be exited. All right, hopefully that's clear. So now let's look at results of doing something like this. Again, here's the chart again. So here we had a 5-day closing low, bought the gap down, waited till it closed at a 5-day high, and we're out. You can see this is what was happening. There's the 5-day low, it gapped up, pulled back, so we got the entry there, and then you sell into the rally here. Okay. Again, here, this one gapped down, so we got it a little bit of discount to the 5-day low. Went up and down. This was not a 5-day high, right? This was at the time. So it had to wait through another little dip there, and then we sold right there for a little profit. So this happened again and again. You get the loser here by buying the 5-day low, and then it doesn't bounce for a while. So finally it did. We get a 5-day high, and you exit into that. Okay. All right, let's look at the results now. Over time, this goes back to 2007. This is updated through last month. There would have been 175 trades. 72% of them would have been winners. The average trade would have made about 0.4%. That's 400 on 100,000. Total profit is 67,000. Profit factor of 1.58. So not bad. In the market, 1,024 days. So you can figure you're looking at a little over 10 years there. It's in the market a little less than half the time. Actually, at 250 days, 10 years, that's 2,500 days. So it's about 40% of the time it's been in the market. Okay. So 60% of the time it's not in the market, which is a good thing. Profit factor is something that I should talk about here a little bit. And what profit factor is, it's the gross profit, in this case 182,000, divided by the gross loss, in this case 115,000. So that comes to 1.58. Profit factor is a way that system traders will often compare systems. So if two systems make the same amount of money over the same amount of time, let's say $10,000 over the course of a year, One of them does it by having $20,000 in gross profits and $10,000 in gross losses. That would be a profit factor of 2. It's generally regarded as pretty good. If the other one did it with $100,000 in gains and $90,000 in losses, that would be 100 divided by the 90, which is 1.1111. That's not looked at as favorably as the previous system based on profit factor, right? There's other things you can look at, but for the most part, it took a lot more effort to make the 10,000, and you had to endure $90,000 worth of losses to get there, as opposed to having the 20,000 in gains and 10,000 in losses. Seems much easier. So that's what profit factor looks at. It's a metric I like to look at as well. Okay. Whenever I look at a system, I also like to look at the profit curve. So this profit curve is actually not too bad. We see, it's choppy along the way, but without any other filter, just buying a 5-day low and selling into a 5-day high, it's done quite well over time. And this includes going through the 2008 bear market, 2011's in here, all the dips over the last 11 years. So that's pretty impressive. All right, I'm going to show how to improve that a little later on. Now let's look at a simple seasonal strategy. This seasonal strategy looks to take advantage of the tendency for the market to rise around the turn of a month. Okay, so we're going to look to buy, again, I'm using SPY here. We're going to buy SPY if today is the first trading day after the 24th of the month. All right, so with the calendar here, you're looking at if 24th is on a Monday, today would be Tuesday the 25th. We're looking to buy SPY at the open tomorrow. So in many cases, that'll be the 26th. But if the 24th happens to fall on a Friday or a Saturday, then whatever that Monday is would be the day you're buying after, right? So the 24th was here. I'm sorry, if the 24th was Saturday, 25th would be Sunday, 26th would be Monday, you'd be looking to buy on the 27th. All right, the exit's even easier. You exit at the close of the first trading day of the next month. So we're selling the close on the 1st, or whatever the first trading day was, right? If the 1st was on a weekend, then it would be the 2nd or the 3rd. That's all the system's doing. Let's look at results here. Here we're looking at 37,000 in profits, pretty good. Profit factor 1.46, again, pretty good. It's been profitable a little over 60% of the time, and the average month would have gotten you about 0.3%, so not bad. Let's look at the profit curve. And that's moved its way from lower left to upper right. Been choppy along the way, admittedly, but really not a terrible curve. That's pretty impressive for such a simple concept. All right, pretty good, but how do we improve them? Those are two systems that I consider both have edges. I think you would make money in both of them over time if you traded them consistently. I don't consider them very tradable, and I'll tell you why. It's hard having confidence in either of those systems without taking anything else into account. If we are at a 5-day low and it's an ugly 5-day low and there's all kinds of stuff going on in the market, it's going to be very easy to say, whoa, I think I'm going to back off this one. If there's ugly things happening near the end of a month, very easy to say, whoa, back off this one. Those may be the best opportunities. They may not be, but they may be. So it's helpful to have some type of confirming evidence. It's helpful from a trader standpoint to have confirming evidence, just so that you have more confidence in your trade. And if your confirming evidence is any good, it'll help the results as well, right? So you'll know that. So let's talk about a few concepts that I've incorporated into the InvestiQuant swing edges, and then we can think about how we can incorporate that in there. So one is acceleration, and this is what our systems look at. We have 3 systems that look at acceleration. Acceleration means how fast is the market moving and from where. So in this particular chart, you're seeing we got a consolidation, sideways move, and then you get a big move down out of that. And the numbers you get, or the edges you have coming down sharply out of a sideways consolidation, are different than if you saw this sharp down move occur after a long run up, similar to what we're seeing now, right? We got a sharp move down after a long run up. Or if you've got a sharp move down after a long run down, or if it's a weaker move, or if it's a move up that's very sharp or not very sharp. So that's what acceleration's measuring. How fast is the market moving? And where's the move originating? Okay? And that's what that's the basic idea behind it. Next, we have momentum. Now, momentum looks at how persistent the move's been over the last few days and weeks, and then how strong is the movement and where is it trading in relation to the long-term trend. All right. So we're looking, this is more for persistency than speed, right? But are we moving steadily up? Are we moving steadily down? Are we moving steadily sideways? Is it a bunch of chop that we don't have steadiness in? Are we constantly flippy flopping back and forth, right? So our momentum indicators look at that, and they've been very useful in determining, all right, in similar market conditions with similar kinds of momentum, the market's done this or that, right? So that's what that's what we look to measure. Seasonality, we already talked a little bit about end of month seasonality, but there's a lot of different ways you can measure seasonality. And one of the ways that it can be measured is, for instance, day of the month or day of the week, or you can look at holidays. I'll share some studies later on looking at special days. You can look at cycles, right? Presidential cycles, or liquidity cycles, moon cycles, whatever you have. There's the number of different ways to look at seasonality. We've taken what we believe are to be the best cuts and slices of it and created 3 different seasonality systems that look at over the next 1, 3, and 5 days, just like momentum systems and acceleration systems. So in doing this, we created guides, and the guides really show historical odds of a symbol or a market closing up or down, over the next few days. There's 9 total systems. As I mentioned, 3 of each: acceleration, momentum, seasonality, and they all look at 1, 3, and 5 days, and they're different systems. So the 1-day acceleration system uses actually different readings than the 5-day. The 3-day seasonality system is based on completely different seasonality concepts as the 5-day or the 1-day. All right, already mentioned 3 different methodologies, 3 different time frames. So what we do is take a snapshot of similar conditions over the last 10 years, and then we measure how the market has done. And we look at the win rate and profit factor over the next few days. We already discussed what profit factor means. And we validated this back to 1971, and we tested it across a lot of markets. But the basic idea is what we're looking to do is identify when there's a clear short-term directional bias. And it's based on our historical analysis. So we want to see all these different things pointing in the same direction, right? Different, you can illuminate something much better with many different points of light. Your edges are much better, typically, if you've got a bunch of indicators saying the same thing. A bunch of indicators that aren't based on the same necessarily idea. Okay. So what if we combine the 5-day low-high timing strategy with some of the IQ swing edges data? right? I've got this neat little timing strategy, and I've got this robust data. Let me try and do that. So this next slide looks at performance following times where we had a 5-day closing low, and then our swing guides for SPY had a win rate of at least 55% and a profit factor of at least 1.3. Those are numbers I've used for years, both for overnight trading and for swing trading. And a 1.3 means you can expect to have 30% more in gains than losses over the long run, right? So you got a decent edge, and you've got the 5-day low strategy at your back. So combining those two things, we're gonna, like we did with the 5-day low, 5-day high, we're gonna buy next day limits price, and then we're gonna sell when it closes at a 5-day high, or after the swing edges no longer meet that criteria. So that's the big difference there too. So we're not necessarily waiting for the 5-day high. If we get some other signal, if seasonality turns bad or momentum turns bad or whatever it is, and it turns bad enough that we're no longer showing an average win rate of 55% or an average profit factor of 1.3, we're out. All right, with this, as you can see, we got about the same in profits. I think it's a little more. I'll show a comparison between the two. Profit factor's improved, your average trade is improved, and you're in the market a lot less. So that's the kind of things you want to see when you're thinking of putting in another filter into a system. And here's the profit curve. Looks a lot better than the old profit curve I showed you, not the big dips. There was one big, I think that was 2011, where we had that dip there with the between trade 50 and 60. And that was in the trades I was taking, I had a dip in my account too. But like this, I've been able to fight out of it and prosper over the last several years. So sometimes you get these dips, and we might be having one now. 5-day low has gone on to make more lows right now if we're looking at the market. So with and without swing edges, I did a little comparison table here. What you're looking at is without swing edges, there's 175 trades. With swing edges, there's only 142 trades. So there's 33 less trades. So that's an improvement of 19%. You're in the market almost half the time as you would be without the swing edges. So that's a 48% increase. Net profits are almost identical, pretty amazingly. Average loss is substantially smaller if you're demanding to have swing edges on your side. Max drawdown is substantially lower, and the average trade is 24% bigger. So fewer trades, fewer days exposed to the market, higher profits, smaller losses. That's what you want when you're adding filters, right? So those are the kinds of things you want to look for if you're going to add a filter other than the swing edges data, which you can. You can take that simple system and add other filters to it. You'd want to be looking at things like this. Are you reducing the number of days invested? Are profits staying the same or getting better, hopefully? Average losses, drawdowns, so things like that. All right, what if we combine a seasonal strategy with IQ swing edges data? Same concept here, except now we've got strong seasonals, and basically what I wanted to do is say, all right, I'm not going to be that picky about having the IQ data show a strong edge. Let's just say there's not a downside edge here. So we've got a decent system, and we're going to use a loose filter. So in this case, I want to see a win rate of at least 50% and a profit factor of at least 1.1. And if that happens, I'm going to buy tomorrow at the open, sell the close the first trading day next month, or at the open the morning after the win rate and profit factor are no longer met. So in this case, while we're waiting for the 24th of the month, we're also double checking to make sure the swing edges data isn't bearish on us. Okay, and there may be months where there's no trade if the swing edges data is bearish the whole time, and there may be months where there's multiple trades. You could get 2 trades, right? Because you could get in, and then it turns bearish, and then you're out, and then you get back in again. And the reason I say today's after the 24th of the month, but not the last trading day of the month, is then it wouldn't be a swing trade, because then you're buying the next morning and you're getting out that afternoon, so that's a day trade. So that's why we eliminated that. All right. Here's a look at the profit curve. Much improved from what it looked like before. And then let's look at the comparison. Interestingly, the number of trades turned out to be exactly the same, because some months there was 0 and some months there was 2, and those months evened out. Number of days invested was reduced though, right? You're only in the market, you're in the market 19% less of the time. Profits were 26% higher, so less days invested, substantially more profits. That's interesting. Average trades 26% better, and your max drawdown is much better, 55% better. So less exposure, much less drawdown, substantially better profits. Those are the kinds of things you want to look for when you're adding filters. All right. Let's talk about a few studies from the IQ Swing Navigator. I'll show at the end of the presentation, I'll show that slide again that allows you to sign up for a free trial for the Navigator. But what I do in the Navigator is I will take the swing edges data and I review that every night. And then I'll put in some special studies once in a while looking at, hey, all right, so what are the odds based on the fact that we've got good numbers from our systems, from the swing edges systems, and the market's set up in this manner, whatever that manner might be. So a little while back, I broke down the bullish odds by market position. And I looked at it 3 different ways. So the first way was, all right, let's say we got strong odds, but SPY is already overbought, right? So SPY is at a 10-day high. Swing edges are looking pretty good. We're over 55 and we're over 1.3. So that's normally an area where I'd be interested. But when we're already at a 10-day high, what you can see here is break-even numbers and a big choppy, messy curve. So this is the kind of thing where it generally is not appealing to me, right? If I see the market's already at a 10-day high, that reduces my reward risk potential. Right? I've got higher risks in that it might pull back. I've got lower reward in that we're already overbought, and unless it's going to be a blow off top, then you're not going to get that oversold explosion upwards, right? So that was a little bit eye-opening. Now, what if it's not overbought? What if we're less than a 10-day high? That's all we're looking at here. SPY closes less than a 10-day high, and we got good numbers. Now that's a system, right? Total profits are strong. Profit factor jumps from, what was it, 1.1 on the last slide to 1.9 here. You're right on most of your trades, and the curve looks just like you would want it to look, right? Heads higher over time. A lot of new highs, not a lot of big dips. And then lastly, we saw what happens when it's overbought. We saw what happens when it's not overbought. What about when it's oversold? So here, swing edge is 55, 1.3, but SPY is at a 10-day low. Now we're looking at even better numbers. Profits aren't quite as good here, total profits, because of the fact that you're not in it nearly as much. It's less trades. Your profit factor, though, has jumped up to 3. That's a big profit factor for a system like this. So, and as you can see, this one didn't even start off all that well, but it's done very well in the last several years, right? The first few trades, looks like the first 6 or 7 trades there on the chart, there was a little bit of a struggle, and then trade 9 maybe, it boomed. And It's mostly gone up since then. So oversold combined with our other evidence, our good numbers, is impressive. Now, I was using 10-day highs and lows in the letter, so it's a little different than our 5-day high-low close system, but same type of concept, right? All right. Another thing I do in the Navigator is I will look at seasonal edges, and not just using the IQ Swing Edges seasonal guides. I will look at them specifically at times, and other times I'll show studies related to what's going on, time of the month, time of the year, you know. And one thing I do is Fed days. So this is a sample of a Fed day edge, right? Fed days. I'll also do other holidays. I'll look at employment days or OPEX days, things like that sometimes. But Fed days have been something I've looked at for a long time, and they have shown a persistent bullish edge over the years. Now, Fed day, for those that aren't aware, 8 times a year the Fed has a meeting. These days, I think it's almost a 2-day meeting. It used to be they had some 1-day meetings and some 2-day meetings. The day that the meeting ends, they have a policy announcement. It's at this policy announcement where they will typically raise rates, lower rates, say rates are staying the same, and then they'll say something about the economy or the markets. They'll make some comments. Fed days have done exceptionally well over the years. Now, could be government conspiracy. Could be that for the most part, the Fed is there to calm the markets, right? So if you're in a panic a lot of the times, or not necessarily a panic, but if the market's struggling, the Fed will come in and say something that will encourage people a lot of the time. That doesn't always happen when the market is posting new highs, right? Then it's their job to keep it from getting too overheated, or that's how they view their job. So I broke it down looking at, all right, what if the market closes at a 20-day high, and what if it doesn't close at a 20-day high? When it's at a 20-day high, it's overheated. The Fed doesn't need to do anything to calm the markets. The Fed can even say negative things sometimes to try and calm it down, to try and, you know, keep it from getting too overheated. But this chart, going back to 1982, looks at times where you're not at a 20-day high. And as you can see, it's been a strong upside edge over the years. I don't show it on here, but the average Fed day in this case has earned something like, I think it's 5 to 7 times that of the average day. So it's a substantial edge. And it's been a steady one. This is what happens when it closes at a 20-day high going into a Fed day. Like I said, there's no reason for them to try and save a market that's already at a new high. They don't need to talk it up. A lot of times they might talk it down. And you see the result here. No real edge. I wouldn't call this bearish. This isn't a curve I'd want to trade, but it's certainly nothing like the previous one. So these are the kinds of things I like to break down sometimes. And that's what you'll see in the Navigator, along with detailed system analysis of what the swing edges data is doing. So in summary, overbought and oversold on its own, looking to buy, 5-day low, sell a 5-day high, can be an effective approach to swing trading. If you do nothing else, you can take a method like that 5-day low high strategy and make money with it. Not all the time, but over the long run, buy low, sell high should make money, right? Seasonality is another thing that can provide substantial edge to traders. The one seasonal system I gave here is an example of that. Fed days are another example of that. You take Fed days and turn of the month and just own those days, you get a decent chance of making money year to year. Okay. And then simple edges, little things like that turn of the month, little things like that 5-day low, 5-day high. You can magnify those edges when you combine them with other tools. Now, I showed the example of one of my favorite tools, which is the IQ Swing Edges, but you can combine it with any tools you use. Take a 5-day low high strategy, take a end of month seasonal strategy, and apply your Japanese candlestick or Fibonacci or whatever methods you want to use to try and improve those edges. And if you have some simple edges on your own that you trade, there's a good chance you'll be able to improve them using overbought, oversold, or seasonality. All right, so that's about it. We got 7 minutes left here. I promised about 10 to answer questions. So I'm happy to answer any questions. I ran a little bit longer. I talked a little bit more than I maybe should have. investquant.com/swing trading trial will get you a free trial of the Navigator. I think that you got to pay attention to the caps there in swing trading and trial. And if you have any questions, I know a lot of people will see this webinar after it's over, see a recording of it. So if that's the case, feel free to email me at rob@investquant.com. Be happy to answer any of your questions regarding anything I discuss here or in or anything else with regards to InvestQuant, swing edges, my own trading, swing trading, overnight trading, what have you. So I'm seeing, I just pulled up the, sorry, I just pulled up the question box. Any currency futures systems? No. Are you selling your indicators? I think this question is for me, I'm not sure. Yeah, you can buy these swing edges guides. Check them out at InvestQuant as well. And they are on, they look at 58 different ETFs, I think 7 or 8 different futures, and about 150 or 200 different large cap stocks. So you can see odds for all of those with the swing edges subscription, sorry. But yeah, check it out at investquant.com. I'm not seeing any other questions come in. Oh, one thing I didn't mention is Navigator currently goes for $950 a year. That may be going up very soon, but for now, that's the price. You've got full trade idea history you can look at there as well when you take the trial, and you get a lot of ideas from how people use the Navigator to trade, ETFs, options, futures, all kinds of things. So I would encourage you to check it out. It doesn't cost anything, and like I said, there's a lot of people that have benefited from it over the last 2+ years. December of 2015 is when I started it.